All right, let's look at an example. Okay. So let's say we have an example where this PCC corporation donated $700,000 of cash to the American Red Cross. Their taxable income before the charitable contribution, NOL carryover, and dividends received deduction was $6,287,000. The question is, what is their charitable contribution for deduction for the year? And what, if any, do they get to carry forward? Okay. All right. So let's look at this. So I'm going to insert a table here. Okay. And I'm going to talk about what each of these items are. Okay. So taxable income before any charitable contribution that was given to us. All right. We were given the NOL carry forward from the previous year. We know the charitable contribution limit, modified taxable income. Okay. So those are those two things added together. Total contributions for the year were $700,000. The limitation in this situation, we're going to use 10%. Okay. So assuming they didn't make a proper election, and that would give us a deduction limitation of $626,300. Okay. In that situation, they would then carry over the excess. Okay. Remember that this carryover expires. Oops. Well, let's do this then. The carryover expires if it's not been used in a 5-year period. So I apologize for the animation there. Okay, so that's charitable contributions, right? The next important topic is the dividend received deduction. Okay, and remember that we have multiple levels of this dividends received deduction. Okay. So if you own less than 20%, you get a 50% dividends received deduction. If you own at least 20%, but less than 80%, you get a 65% dividends received deduction. And then if you own 80% or more, you get 100% dividends received deduction. Remember too that there are some limitations. Okay. So let's look at an example. Okay. So in this situation, we've got two scenarios. All right. We've got a scenario assuming that they are a 10% owner. And then we have a scenario assuming they are 60% owner. Okay. They're receiving, in each situation, they're receiving a $200,000 dividend. Okay. Their taxable income is $2,100,000. And then they've got a $40,000 net operating loss carryover and a $100,000 charitable contribution. Okay. I'm going to add another slide in here for scenario B, but let's get scenario A in here first. Okay. So this is assuming a 10% stake in the corporation. Okay. So we know that they own less than 20%. So their DRD percentage, DRD percentage is 50%. Okay. If we were to calculate their full DRD, that's going to be $100,000. Okay. So now we need to look at their modified taxable income. Okay. All right. So their modified taxable income for the limitation is $2 million. Okay. And so their taxable income limit is 50% of that. So that's $1 million. And their full $100,000 DRD, oops. Sorry. hold on, their full 100,000 DRD is less than their taxable income limit. So they get to deduct the entire $100,000 dividends received deduction. Okay, so that's if they were a 10% owner. Now, the other scenario was, what if they were a 60% owner? Okay, so let's look at what happens if they're a 60% owner. Okay, well, if they're a 60% owner, they own 20% or more, but less than 80%. So their DRD percentage is 65%. Okay, so we know that. So now we have to figure out what their full DRD is. So that is going to be 65% of 200,000. All right, so that's 130,000. All right, their modified taxable income for the purposes of the dividend received deduction. Right? Taxable income limit is $1.3 million. And again, that full $130,000 dividend received deduction is less than their taxable income limit. So they get to deduct the entire $130,000 dividends received deduction. Okay. Remember that from a corporate tax rate perspective, they have a flat tax currently of 21%. Okay. There are lots of interesting compliance details. Okay. So this relates to a lot of the practice problems that we do for this chapter, because book to tax differences are called M adjustments. Okay. And if you're a small corporation, you're going to complete a Schedule M1. If you're a large corporation, you're going to complete a Schedule M3. Okay. Obviously, we have due dates. Okay. You get an automatic 5-month extension. Okay. And here's a cool thing about consolidated corporations. So consolidated corporations, you can have an affiliated group, and then essentially they're treated as one corporation. You can net gains and losses across affiliated groups. Okay. What we have here is just an example of what a Schedule M1 looks like. And we will talk more about this as an in-class item, but you can see this is essentially a just a true up of book to tax differences, right? And how you get from net income per books to income for tax purposes. Okay. Estimated payments. Corporations with an income tax liability of $500 or more are required to pay estimated tax in quarterly installments. They're due the 15th day of the 4th, 6th, 9th, and 12th month. Okay, notice it doesn't give the name of the month, because this is based on a fiscal year. Not all corporations are calendar years. Okay, they have penalties for underpayments just like individuals do, and the payments are based on whatever the required annual payment is. Okay. So there is an annualized income method. All right. And then this would be how you would calculate the amount of tax to be paid under the annualized income method. All right. That completes the lecture portion of Chapter 5.